Hello, this is Ernest Burley Jr. coming back at you again with some more great information. I am your certified financial planner. I'm your chartered financial consultant. I'm your NFLPA registered player financial advisor. I'm your investment advisor representative. I hold the Series 6, Series 63, and Series 7 licenses, securities licenses. I'm also your author of two books on money management, easy as one, two, three, and money management from grade school to grad school. Be sure to check out those books. I've heard they're very good. And ask your friends to do the same, and so on and so on. They're on Amazon, so please go check those out. I'm also a licensed insurance agent with over 30 years experience, and I've been in business over 25 years. So yeah, we're here to try to just give you some good information. So I specialize in wealth management. I specialize in investing for clients, whether it be IRAs, 401k plans, investment portfolios, asset protection, so protecting what people have accumulated, also asset growth, because of course you want to grow the assets that you have accumulated, financial planning, whether it be basic financial planning or comprehensive financial planning, all different types of insurance, whether it be life insurance, long-term care, disability, auto, home, business, church, contractors, all different types of insurance. And I have clients all across the country. So state lines don't restrict Burley Insurance and Financial Services from helping individuals in the various arenas of financial services and or insurance. All right, the purpose of this podcast is to educate you, to enlighten you, to empower you with clear, objective, unbiased information to help you make some good decisions for yourself, for your family, for your coworkers, for your church members, for your business, for whomever or whatever, right? So we like to just have great topics for you to better your life and hopefully better the lives of others, right? So let's jump right into today's topic. Today's podcast is titled, Reduce Your Tax Bite. And people think about this all throughout the year, really. But when it comes tax time, people are really focused on how they can reduce their tax bite. But truthfully, throughout the year, people are really thinking about that. But come tax time, it just comes full circle and it becomes more of an important topic for a lot of people. So whenever someone is coming to me and saying, hey, Ernest, I'm getting killed by income taxes or what have you, I need to save myself some income tax bite. I need to do something to protect myself from paying so much in income taxes. And they come to me for investment strategies or for advice. And the first thing I always advise people to look at is their retirement plan at work. Now, some people have already done that, but a lot of people have not. So your retirement plan at work is your first line of defense or first line of offense, right? So the amount of money that you put into that retirement plan at work reduces your taxable income, dollar for dollar, reduces your taxable income. Now, the current limit is $20,500. That's a lot of money that you can put away and reduce your taxable income by that amount. So if you make $100,000 a year and you put away $20,500 into this plan, you're only taxed on $79,500. So that's a great reduction on your taxable income. Now, if you're 50 or older, you can put away an additional $6,500. So you can put away $27,000 into your retirement plan at work. So that's the first line of offense that you want to take advantage of if you want to reduce your taxable income. So let's make sure we're taking advantage of that. Now, if you're married, that doubles the ante, right? So instead of just doing $20,500, you got $41,000 to reduce your married filing joint taxable income. If you're 50 or older, you have $54,000 instead of $27,000, right? So these are huge ways to reduce your taxable income by contributing to your retirement plan at work. Now, you want to make sure you're properly diversified, so you're making some good gains in there, good potential gains. But yeah, that's the first thing I always advise clients to take a look at. The next thing, IRAs. Now, different IRAs have different types of advantages, right? So your Roth IRA is going to be a future tax advantage there, because if you hold it at least 5 years and until age 59 and a half, the growth on your Roth IRA is tax-free to you. I like tax-free over tax-deferred all day long. So that's a plan for future benefit, right? Because you can't take a deduction for a Roth IRA. The money you put into a Roth IRA is after-tax money, but the benefit down the line, I love that. Any money that you earn is tax-free as long as you hold it 5 years and until age 59 and a half. Now, if you want to reduce your current taxable income, you have to look at a traditional IRA. So the traditional IRA, you can put away up to $6,000 into there, If you're 50 or older, you can put away $7,000. And if you put away that money before income tax filing, you can double it up. If you didn't contribute the previous year, like say this year, you say, hey, I didn't put anything away last year, and you haven't filed your taxes yet this year, you can put away like $12,000 into your traditional IRA, $6,000 for last year and $6,000 for this year. If you're 50 or older, you can put away $7,000 for last year and $7,000 for this year. So that's $14,000 to reduce your taxable income in addition to the amount that you put away for your retirement plan at work. Now, here's the catch with that. There are income restrictions. So if your income is too high, now go to irs.gov. They have all the limits there. So I think the limit for single is around 68,000. If your income is above that, then you can't reduce your taxable income. You can't take a deduction for the contribution to that traditional IRA. Married filing joint, I think is maybe around 109, starts phasing out to like 120 or something like that. But go to the IRS website, go to irs.gov and just search, IRA income limits or what have you. And those limits are right in there because it varies depending on your status. Single, married filing joint, head of household, blah, 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 right? So those are two solid ways to reduce your taxable income right there. The IRA comes with that caveat though, of course, right? Okay, because your income does determine whether you can deduct that or not. Now, the next way is a legitimate business. And we talked about this in a previous podcast regarding, having a business and being able to reduce your taxable income by the legitimate business expenses. So please, please, please take advantage of that. If you have a legitimate business, you want to deduct as much as you can from that income, take all of those business expenses and make those deductions to reduce the taxable income. Also, you should be an employee of your business. So your income from the business, and you're paying yourself a salary, is a deduction from the business. And then you set up a retirement plan through that business and you contribute to your retirement plan and reduce your personal taxable income that you have received from that business endeavor. So there are a lot of ways to reduce your taxable income. Those are some key ways right there that you want to make sure of. And if you have employees, of course, that reduces the taxable income from the business level, right? So those are some key ways to reduce your current taxable income. Now, here are a couple ways to reduce future, or basically some tax benefits future down the line. Okay, so cash value life insurance, right? So here you go. The cash grows tax deferred, and it can be used as a loan later on down the line without you paying taxes on it. Like I said, that's down the line. That's not a current taxable tax advantage for you to reduce your taxable income. But down the line, that's a definite tax advantage. But this is not for most. Now, I'd only recommend this for someone who is very cash heavy after they've taken care of all of their other financial planning situations. So they have the emergency savings, they max their retirement plan, they have the disability coverage, they have the long-term care coverage, they have life insurance, they have everything in order as far as their financial planning is concerned, and they're still cash heavy, and they want to take advantage of some tax qualified type plan, not tax qualified, but tax deferred growth on their money. Cash value life insurance can be an option for someone like that. It's not for most. The advantage includes, like I said, it's basically for someone who's cash heavy. They have a need for life insurance and they want to reap the benefits of borrowing against the cash value in future years. Some of my clients fit that description. I have some, a lot of my clients are multimillionaires, so they do fit that description, and this plan would be for them. But like I said, that's the vast minority of the population. Most people this is not for, because they don't have enough money to have all these other areas shored up and then still be cash heavy. Right now, you want to make sure, if this is good for you, that you don't mech it up. Right. I didn't say mess it up. I said mech it up, MEC. And mech stands for modified endowment contract. Now, if a life insurance policy becomes a mech, then you automatically are going to be taxed on the money that you pull from that account. Basically, it turns it into sort of like a retirement plan. So if you contribute too much money to these life insurance policies, it turns into a mech. And once it's a mech, you can't unmech it. Once it's a mech, always a mech. So you want to make sure you stay within the guidelines as far as how much you're paying for a life insurance policy, because if you're paying too much, you're going to mech it. You're going to mech it up. And you'll have to end up paying taxes on the money, which totally defeats the purpose of you wanting to get that plan. If you're saying, hey, I want tax deferred growth and to be able to take loans against that cash value down the line without paying taxes on that money that you're loaning from the cash value in the policy. So that's another way, future benefit, not current, reducing taxable income. And also real estate. Real estate is a way now, equity in your home, that's a way to have future benefit as far as your taxes are concerned. Please listen to my podcast on real estate or a real mistake. The title of it is Real Estate or Real Mistake, because you want to make sure you're in a good financial position before you get into the real estate arena. Real estate is an illiquid asset. It ties up your money. So you want to do your research, be wise about stepping into the arena of real estate or owning real estate. But it is a definite advantage. I recommend everyone own real estate, but you want to be in a good financial position to do so. So now here's the future benefit for future tax benefit for having real estate. The capital gains that you have in your primary home, hey, you don't have to pay capital gains tax on the first $250,000 of gain. So say you bought a home for $200,000 several years ago, you've lived in it 2 of the last 5 years. You have to live in it 2 of the last 5 years as your primary residence. And you say you make $300,000 on the sale of that property. Well, if you're single, you get to keep $250,000 of that without paying capital gains tax on it. If you're married filing joint, up to $500,000 in capital gains tax from selling that primary residence. So yeah, that's great. That's an awesome way to like get a tax benefit from owning real estate. Now, if you have an investment property, you can still take advantage of gains that you accumulated within a property, basically equity, by doing a 1031 exchange. So a 1031 exchange allows you to take the gains from that one investment property and move it into another investment property. So you don't have to pay taxes on that money. So say you have $100,000 in equity in this property, and if you sell it, that's going to be $100,000 in gain to you. You would have to normally pay capital gains tax on that investment property. But if you move it from one property to another property in a 1031 exchange process, you don't pay any taxes on that gain. Now, that is a very detailed and specific process, the 1031 exchange. You need to start in advance, and you have to follow all the guidelines to make sure that you dot all your I's and cross all your T's to take advantage of that situation, okay? So that is it. That's it. I just wanted to hit these bullet points for you on how you can reduce your tax bite currently and future-wise. But I know a lot of people are thinking about, how can I do it right now? And those first 3 points are the main ones: the retirement plan at work, the IRA, depending on your income situation, and also any legitimate business that you have. You can reduce your taxable income in various ways there at the business level, and also at your personal level when you pay yourself income from that business. Okay, that's it for today's podcast. Okay, so what I want to do is give you a quick recap. So the recap here is we want to reduce our tax bite however we can. So reduce your tax bite however you can, and think about that all throughout the year, not at tax filing time only, right? All throughout the year, let's make sure we're trying to reduce our tax bite. Okay, takeaways. Main takeaways are the points that I kind of mentioned to you. Basically, the retirement plan at work, IRAs, also. Now, I forgot to mention spousal IRA, right? So if you have a spousal, like if your spouse doesn't work, you can still do a spousal IRA. So that's another type of IRA that can reduce your taxable income, even though one of the spouses like does not work and stays at home. So yeah, I forgot about that. I'm sorry. I'm glad I brought that up. I thought about that. So let's make sure we take advantage of that too, because that's another $6,000 or $7,000 that could be put away to reduce the taxable income of that household married filing joint. Okay. All right. So there you go. And also we talked about legitimate business. We talked about the cash value life insurance for future benefit, tax deferred growth, and being able to use that money without paying taxes on it. And also real estate being a viable option in some situations too, but you need to be in a good financial position to take advantage of that particular situation. But that's for future growth, right? Future tax advantage. It's not currently reducing your taxable income, right? That's it. Okay, so I'm going to sign off. I thank you guys for listening in. I really appreciate you listening in. I ask that you forward this podcast to others and ask them to do the same, and so on and so on, so we can make these podcasts go viral. If you want to connect with me, very easy to do. It's just my email address is my first name at my full name.com. So Ernest at ernestburleyjr.com. Ernest, E-R-N-E-S-T, at Ernest Burley Jr., E-R-N-E-S-T, B-U-R-L-E-Y-J-R.com. My website is my name, ernestburleyjr.com, www.ernestburleyjr.com or ernestburley.com, either way. And my phone number is 301-262-2600. Again, that's 262-2600, 301 area code. Okay. All my podcasts are on YouTube, so please go to YouTube and check out my podcast. And I also have some 1-minute snippets on there, talk about a wide array of topics, everything from real estate to investing to financial planning, insurance, all different types of insurance, entrepreneurship, minding your business, making sure you're doing the right thing to be a successful business owner, all that good stuff. So I ask that you view the various podcasts on there, see what may be of interest to you, and also subscribe. I ask that you subscribe to my channel. It's just my name, Ernest Burley Jr. So check that out. And also ask your friends to subscribe. So, hey, go check out this guy's YouTube channel. He's talking about various insurance things and investing and financial planning and what have you, whatever topic you can think of. I probably have it on my YouTube channel, and ask them to subscribe also. Okay, I appreciate it. Now, since I explained to you that I am a financial advisor and do some things in the investment arena and wealth management, I do have to go over disclosure real quick. So Burley Insurance and Financial Services, Inc., 13621 Annapolis Road in Bowie, Maryland, 20720. That's where my firm is located. Even though I have clients all throughout the country, my firm is in Bowie, Maryland, which is outside of Washington, D.C. Securities and investment advisory services offered through Next Financial Group, Inc., member FINRA SIPC. Burley Insurance and Financial Services, Inc. is not an affiliate of Next Financial Group, Inc. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Past performance does not guarantee future performance. All the views expressed are those of Ernest Burley Jr., that's me, and Burley Insurance and Financial Services, Inc., and not those of Next Financial Group, Inc. Next Financial Group, Inc. does not provide tax advice. Neither do I. So those things I was talking about, speak with your accountant about that to see how that works into your personal situation also. But hey, that's it for today's podcast on reducing your tax bite. Please pay attention to this during tax time and throughout the year, not just at tax time. And please forward it to others and have them forward to others, and so on and so on. It's been another great day. Hopefully y'all got some good information. I look forward to our next visit, our next podcast. In the meantime, y'all take care and y'all be safe out there. This is Ernest Burley Jr., your certified financial planner, your chartered financial consultant, your NFLPA registered player financial advisor, your author of 2 books on money management, easy as 1, 2, 3, money management from grade school to grad school. I ask that you pick those up and ask others to do the same. Y'all take care. Until next time, be safe out there.